Our top focus on the show. Gold traders received major relief after Trump confirmed that gold imports to the U.S. will not face tariffs. That ended a week of speculation that had rattled the precious metals markets. The uncertainty began last week when the U.S. suggested the possibility of country-specific import tariffs on standard 1 kilo and 100-ounce gold bars. The message sent shockwaves through commodity markets, driving gold futures to a record high of $3,534 per ounce before prices eased after the administration promised clarity. Experts say that the decision to avoid tariffs reflects gold's unique role in global finance. Unlike industrial goods such as steel or automobiles, gold is considered both a commodity and a monetary asset. It is held by central banks as a reserve used by investors as a safe haven and plays a key role in financial stability. Imposing tariffs on it, experts note, would be like taxing a currency, a move that could disrupt global markets and undermine confidence. A tariff could also have sparked major market mismatch, including price gaps between U.S.-traded gold on the COMEX exchange and the physical bullion market, potentially leading to shortages and volatility. By ruling out tariffs, the administration has eased concerns of such disruptions and reassured market participants worldwide. With the announcement, traders expect greater stability in the bullion market, and attention will now shift back to underlying drivers such as interest rates, currency movements, and geopolitical tensions. For now, gold's status as a tariff-free safe haven, it remains intact. And well, for more on this, we're now being joined by Ajay Bagga, market expert. He's joining us live from Mumbai. Welcome to the broadcast, Mr. Bagga. First up, why has the U.S. not imposed a tariff on gold bars as it had first announced?
Yeah, overall, there was no intention of imposing tariffs on gold. Even in April, the U.S. had clarified because, as you just mentioned, gold is a financial asset. It's not a physical asset as such. India, of course, puts custom duties on gold of about 12%. But there the reason is to stop Indians going on purchasing a lot of imported gold. But overall, if you see, the gold has to flow across economies in a frictionless manner. And in fact, Resha, about $1.1 trillion of physical gold lies in the vaults in New York and London at any time. That's the kind of holdings that are there. And these are then flown on a short notice depending on what trade makes sense. So there are huge trades where buyers buy gold from, say, Africa or Canada or Russia, and that gets shipped to Switzerland. It's turned into gold bars, and then it's given for delivery. All this happens without tariffs. So if one part of it also gets tariffed, the whole chain breaks down. The gold price would have had to reach about $4,700 as against the present $3,400 if that 39% or 35% of gold tariffs had been hit.
Right, Mr. Bagga, just to follow up on that, how could this decision of no tariffs on gold impact global gold trade?
Yeah, we saw, in US, the gold went up nearly $100 per ounce and deliveries were stopped. So all the Asian companies which had to deliver physical gold, they just stopped delivering. And there was talk that some more instruments would be created where physical gold would not enter the US. So we must understand that this physical gold coming in was a financial asset. You did some trading on the computer. You did some online exchange of value, and this was settling that value. It wasn't actually a good, like you mentioned. It's not steel or aluminium coming in. It's a financial asset. So today, the difference between London and New York has come down to below $50. On Friday trading, it had shot more than $100. The difference, and it would have become even higher if these tariffs had persisted. Now the prices are nearer to each other.
You speak of how gold is a financial asset. My last question to you, what does Trump's decision of no tariffs on gold mean for the gold prices now at this point of time?
Normalcy, sanity back. Otherwise, the whole supply chain would have been in trouble. So the price discovery will be much finer. And this is a big cloud that was on the entire global gold trading chain, which has got lifted, especially for Switzerland. Switzerland sends about $61 billion worth of gold to the US. It's not produced in Switzerland. It's mostly refined gold, which is cast into bars. That would have costed the 39% tariffs that have been put on Switzerland. That would have meant $24 billion they would have put on the gold they were sending. So that trade was over. Basically, last week there was a lot of talk that we'll have to create some other instrument based out of Dubai or the Shanghai exchange and settle it. So that overhang goes. Gold price over a 1 year period, we are seeing this hitting at least $4,000. Gold will keep on going up as the fiat currencies are losing value. And in times of turmoil, gold normally does well. The other thing is when the US rates come down, you see that gold, being a non-yielding asset, gold normally tends to appreciate. So there are multiple triggers for gold to go up, and we expect it to keep going up.
Right, Mr. Bhagat, thank you so much for joining us here on WION with your insights.
Thank you, my pleasure.